to those U.S. oil inventories of more than 10 million barrels. The street was looking for a drop of just over 3 million. We've got Andrew Lipow joining us now, president of Lipow Oil Associates. Andrew, always great to talk to you. Can you explain that huge jump in barrels?
Well, yes, I can, and it's due to the fact that the refinery utilization dropped significantly by over 3 percentage points, which is about 500,000 barrels a day due to a number of refining problems on the Gulf Coast. At the same time, imports of crude oil rose nearly 1 million barrels a day from the previous week. So the combination of those two events ended up with a higher than expected inventory build.
Because apparently the WTI Brent spread has been narrowing lately, so that apparently discourages U.S. exports. And I guess the other side is it makes it easier or more economic to bring in oil to the U.S.
Well, the Brent-WTI spread has been narrowing as a result of the Keystone pipeline shutdown. And because we've lost about 620,000 barrels a day of oil into the mid-continent, you now have refiners looking for alternatives. And as a result, they're grabbing for WTI for delivery in January because we still don't have any information regarding when the pipeline is going to be repaired and when it's going to be restarted.
I'm surprised that there hasn't been more impact in this on the spread of Alberta oil, the discount, because presumably this thing is going to tend to trap oil in the province.
Well, that's absolutely right, especially with limited rail capacity and rail cars to move it down to the coast or the United States. But I think there is ample storage right now at Hardisty and Edmonton that's preventing Western Canadian Select discounts from dropping precipitously. But in addition, if Keystone were to be able to restart on the leg from Nebraska over to Patoka, Illinois, that would allow additional egress for Western Canadian Select, because at Patoka they could access the Capline system to get to the Gulf Coast.
That's interesting. So the tendency in Alberta, if they have plenty of storage capacity, they'll say, well, we're just going to put it in the tanks for now, and they don't feel obliged to sell the oil at a big discount.
That's correct. And over the years, we've seen additional storage capacity be constructed in both Edmonton and Hardisty so that the producer didn't have to deeply discount their oil and they could wait. And as time has gone on over the last year, we've seen additional pipeline capacity come online from the Enbridge system.
Factors dominating the oil market. I really want to get your take on the European ban on Russian crude. We've heard far more has been going to Asia. So will Europe be able to just get its oil elsewhere, Andy?
Well, we are underway with a big reshuffling of oil supplies. We've seen the European Union ban has limited the number of customers for Russian oil, and now it's really concentrated between China, India, Bulgaria, and Turkey, and they're demanding ever greater discounts to purchase Russian oil, which is now selling for about $45 a barrel when you're loading it in the Black Sea or in the Baltic. And as those countries buy more Russian oil, they're buying less of something else. That something else is generally Middle Eastern crude or South American crude. So you see that getting redirected into the European market as well as the United States market.
That's interesting. Do you agree that Europe was too lenient with Putin in setting that $60 US price cap? I know it's a politically loaded question.
Well, I think the fact of the matter is that the market is actually now significantly discounting Russian oil to make the price cap rather moot in people's discussions.
Right.
So India can go ahead and buy all the Russian oil they want without having to worry about the price cap because it's only $45 a barrel.
$45 a barrel. Is Putin going to be happy with that? Is that giving him enough revenue?
Well, I don't think it's giving them enough revenue. And while they have limited customers, we also have seen that the tanker rates that carry Russian oil from the Baltics to India has gone up dramatically, as everyone knows that Russia's options are limited into their number of customers and the number of tankers available to them. So while this phenomenon of really low Russian oil prices is really new, it's going to take several months before it starts really impacting the Russian economy and their ability to generate revenues.
The Chinese reopening, backing away from the toughest of the COVID measures, bullish for oil.
Well, it certainly is, but I think a full reopening is several months and quarters away. But I do believe that the full reopening is worth about $5 to $7 a barrel increase in oil prices.
Andrew, where do you see WTI going over the next few months? An impossible question, but I always like to ask you, do you see it higher? Do you see it getting up towards $100 anytime soon?
Well, I don't see $100, but I do see that Brent over the next 3 or 4 months will rise back to $90 a barrel, bringing WTI into the mid-80s. And it's not only the COVID China reopening, but it's the fact that we're going to halt the sales of strategic petroleum reserves, which has been, over the last 180 days, roughly 1 million barrels a day. So the market is going to be looking for alternative supplies for that. At the same time that the EIA has been revising downwards over the last 6 or 7 months the forecast production of oil here in the States. So there is in 2023, going to be an upward bias to price as oil demand around the world continues to ramp up and we lose some of the supply that we've been relying on to bridge the gap over the uncertainty of Russian supplies.